That's actually a really average range for most young Americans. If you're in that range, you're actually pretty average right now. Really important that you understand what credit actually is, what it does for you, and what you can do with it. So, in the United States, your credit history, your ability to manage money in a loan type situation is tracked by a credit bureau. There's actually three credit bureaus that keep track of your payment history and your financial responsibility. And then they attach a score to that, a score anywhere from 300 to 850. If you don't know what your score is right now, that's absolutely the first step you need to take. Go to creditkarma.com. It's a free site that will let you see your credit score, what's going on with your credit, like why it is the number that it is, and then lots of tips and tricks and ways to improve that. Creditkarma.com does not use the same scoring model exactly that the credit card companies and the auto loan companies and the mortgage companies use, but it's close enough. It will give you a really good idea of where you're at, and that's just what we want to do today. Just start with the basics, go from there later. So your score is going to be anywhere from 300 to 850. If you try to create an account on Credit Karma and it won't let you, it means you don't even have a score yet. You haven't ever used credit. In that case, I recommend opening a store credit card wherever you can, preferably a store that you like, and just get a credit profile started. Don't use the card. This is not permission to go shopping. All you want to do is establish yourself as a consumer. What a US thing to say, right? Establish yourself as a consumer so that your credit file gets started. Once it's started, Credit Karma then will show you your score. Okay, so what do the scores mean? So a 300 to about a 579 is considered poor credit. In that range, it means you aren't going to be able to or have a really hard time getting an auto loan, getting an apartment, or getting other credit cards or a mortgage or anything else you're going to need credit for. Below 579 is going to be tough. 580 to 669 is considered fair. A lot more options open up to you in that range, even though it's considered fair. Um, that's actually a really average range for most young Americans. So don't beat yourself up about that. If you're in that range, you're actually pretty average right now. 670 to 739 is considered good credit. A lot of things are going to be open to you in that range, pretty much everything. You're not going to have a problem applying for apartments, getting a car, and your interest rate should be pretty decent at that range. 740 to 799 is considered very good, and anything above 799, 800 and up is going to be considered excellent. So, where do these numbers come from? How do you get a certain number? Well, there are 6 factors that the credit bureaus use to determine how creditworthy you are or what your number is going to be. So, the first and most important factor is your payment history. Do you pay your bills on time? And those bills are the bills that are attached to a loan or a credit situation of some kind. So, credit cards, auto loans, a mortgage if you have one, things that are attached to a credit situation, not your apartment rent because they're not loaning you money. You do have to pay them on time, obviously, but rent doesn't usually get reported to the credit bureau, so it doesn't really factor in to your credit score. But anything where you've loaned money or you've been given a balance to manage, like a credit card, that's your payment history. That will go into reporting your payment history. That is the single most important thing that you can do to protect your credit. One single late payment will affect your credit score fairly dramatically. You can go from good credit to fair in one late payment. And by late payment, here's something you need to know, especially when you're struggling and you're trying to manage things. If you have a credit card payment due on July 1st, let's say, and you don't pay it on July 1st, technically that's late. If you pay it after July 1st, it's late, right? You're going to get a late fee or some kind of service charge from the credit card company for not paying it on time. However, it doesn't get reported as late to the credit bureaus until it's 30 days late. It's the 30-day mark that's dangerous for your credit report or your credit score specifically. 1 or 2 days doesn't show up on your credit report like that. I'm not suggesting you pay your bills a few days late. I'm just letting you know a few days after the due date doesn't affect your credit score. It will affect your relationship with the credit card company in terms of they're going to charge you a late fee, but the credit bureau doesn't really care until you're 30 days late, just so you know. But 30 days, that's where you get dinged on your credit report. 60, even worse. 90, much worse. And every single one of those 30-day or more late payments knocks your credit down a notch, sometimes a big notch, every single one. And it takes a very long time to recover from that. Don't think that if you have one 30-day late payment from a couple of months ago, and then you've been paying it on time since, that it's just going to even out or it's just going to go away. That 30-day late payment will show up as a ding on your credit report for, well, technically 7 years or so. Your credit report will show the last 7 years of on time or not on time payments. So the more on time payments you make, the more that mess up gets buried and has less impact. But just so you know how important payment history is to your credit score, anything below 100% payment history hurts your score. A 99% payment history is not an A. A 91% payment history is not an A minus. 100% is the only number. Everything below that is going to hurt you. That's how important it is. One single missed payment. Okay, I think I've made my point there. The next most important factor is your credit utilization, and that means how much credit do you have versus how much are you using. So if you have let's say a store credit card for $500, that's a fairly common first credit card limit. $500. The credit card company has granted you the ability to charge $500 up front and pay for it later. That's the credit they've given you. If you go shopping and spend that entire $500 and max out your card, you are now at 100% credit utilization. You're using 100% of the credit that you've been granted. You want to keep that number at 30% or below. Don't be maxing out your cards. If you get a credit card and you max it out, if you can't pay that entire amount, that entire $500 when the next bill comes, you're going to be charged interest. So now you owe more than $500, and your credit utilization will show at 100% on your credit report, which is bad for your score. So you want to keep your credit cards below 30%. Lower is better, but definitely below 30. What I would recommend when you're building credit for the first time, if you have that store card, or even better, if you just have a low limit Visa or MasterCard, like a $500 Visa, put your Spotify or your Netflix or one of your recurring subscriptions on that card. Don't use it for anything else. Once a month, Netflix will charge that card for the amount of your subscription. And then you will get a credit card bill, or you will make a note to log into your credit card app. However you do that, make a reminder and pay the credit card bill. It'll be, how much is Netflix now? I don't know. I haven't had it in years. But that's how much you will have to pay off the credit card, get it back down to zero. One, you never went over 30% utilization on that card, but you're using the card responsibly and then paying it off at the end of the month. That looks great to the credit scoring system. That's going to keep your score nice and juicy. Something else with your credit card bill. Let's say you do max out that $500 card. Please don't do that. I'm begging you and I'm speaking from experience. Please don't do that. When that bill comes, you owe $500. Hopefully you have it and you can just pay it right there. But that bill is also going to give you another option. It's going to say you can make a minimum payment of, let's say, $34. Well, that sounds way better than 500. Why wouldn't you just pay the $34 instead of the 500? Well, there are multiple reasons. One, by not paying the entire balance, you're hurting your credit score by not keeping your credit utilization below 30%. Two, you're now getting charged interest on that $500. And that $34 payment barely covers the interest and doesn't make much of a dent in the $500 balance you actually owe. And if you think you can just make the minimum payments until the card is paid off, it's going to take you a very long time. Time where you're being charged more money in interest and time that your credit card utilization is above 30% and hurting your credit score. So if you can't pay that entire $500 off, pay as much as you can. Ignore the minimum payment amount. Pay more than that every time. Pay as much as you can. If you can pay 70% of it, well, that'll keep your credit utilization below 30% or at 30%. So that would be great. If you can't pay the whole thing, pay 70% of it if you possibly can. Keep that number down, keep that balance down. What you don't want to then do is pay off a bunch of that card and then turn around and max it out again. Then you just get into a cycle where you're just you're just maxing it out, paying most of it off, maxing it out again, paying most of it off or some of it off. Don't do that. Again, speaking from experience, please don't do that. Okay, the third most important factor to your credit score, what makes it go up or down, is the length of your credit history. And if you're young and you got a short credit history, there's just nothing you can do about that. It just takes time. Your length of credit history will grow every year as long as you have credit. There's nothing you can do about that. That's just time and that's just waiting. The fourth factor in your credit score is your credit mix. What kind of different types of credit do you have? Do you have a personal loan? Do you have 3 credit cards and a car loan? That's a mix. That's what I'm talking about. If all of your credit is in credit cards, that's not ideal for your credit situation. Now, I am not advocating that you go out and apply for a bunch of different things just to have a healthy credit mix. That's actually going to happen more naturally over time as you're adulting and needing things and applying for a car, a home, another credit card. Those kinds of things will just happen. It's pretty low on the amount of impact it has on your score, but it does have an impact. So just so you know. And the last one, the last factor that affects your score is new credit inquiries or inquiries. That is a hard word for me to say. I don't know why. What that means is every time you apply for credit, the company you're applying with will check your credit score. They'll check your credit report and they're inquiring about your credit. They need to know whether you are a responsible credit user and whether or not they want to give you credit as well. That inquiry affects your credit score. It goes on your credit report. It only affects it a little bit and only for a short time. It's not a huge deal. Where it could be a huge deal, though, is if you apply for a bunch of things really close together and all of those inquiries are stacking up on your credit report because each one is a small ding, not for a long time, but a few months you could recover from that. But each one of those adds up. So don't apply for a bunch of stuff all at once. Those things are reported on your credit report for 2 years, 2 or 3. I think it's 2 years. After 2, they drop off. So that's not a huge deal, but just don't apply for a whole bunch of stuff at once. Not only will it ding your credit slightly temporarily, but a creditor who looks and sees that you've just applied for 10 other credit cards in the last 3 days or the last month, that's a red flag and they may turn you down because they think you're trying to overextend yourself and you could get in some trouble and that will affect whether they get paid or not. So that's how that works. So why is credit so important? Why does it matter? You might be sitting there thinking, "Well, I don't care about credit cards. I'm not going to buy a car." I don't know who says that. Here's why credit is important to you. As boring as it sounds, you're going to need it your entire life, especially if you live in the US. Everything is credit based, it runs on your credit. Not everything, but a lot of things. If you can't buy a car for cash outright, you will need a car loan. Your credit will determine whether or not you get the loan and how much interest you pay. You may not be able to get the car you really want because your credit score isn't good enough to get a decent interest rate, which affects how much you pay per month for that car. You may not qualify for that car you really want because that payment's going to be so high because your credit score isn't strong enough. And you're going to have to opt for a car you didn't really get that excited about, but the payments are what you can afford because the interest rate affects your monthly payment is my point. Want to keep your monthly payments as low as possible, keep your credit score good so you can get a good interest rate when you car shop. Your ability to rent an apartment depends on your credit score and other things. But if you have bad credit, good luck renting an apartment. Anything below 600, you're going to have a hard time getting approved. It doesn't matter how much you make. Sometimes you can offer to put down a gigantic deposit and override that, but don't count on that. A score below 600, you're going to have a hard time renting an apartment with or without a roommate. If your name's on the lease, you're going to need a 600 or higher. I'm seeing it all over the place. This is current information. 600 or above, the higher the better. That's just the way it is. If you're job hunting, some employers will check your credit. Kind of depends on what industry you're in, but be aware that employers can check your credit when you're applying for a job. Your insurance, car insurance, most definitely. The rates you get for that will be dependent on your credit score. People with lower credit scores pay more money for auto insurance. That's one of the factors. Are you needing a new phone? Needing to finance that phone? Your credit score is going to be a factor there as well. If you want to start a business, the bank is going to look at your personal credit score and credit history because the business is too new and doesn't have a credit score and credit history of its own. They're going to look at your personal credit report to determine whether or not to give you a business loan. Keep that in mind. Also, down the road, when you need a mortgage, credit's a huge part of that. So I hope this made sense. Basically, long story short, find out what your score is. Always pay your bills on time, number one thing, and keep your credit utilization below 30%. Those two things right there will be the most impactful on your score. And if you have a low score right now, what do? Here's my suggestion. And Credit Karma can help you with this. And this is also one of the suggestions they make on there. A secured credit card can help you rebuild your credit or get it started if it's so low and there's no record really. A secured credit card works the same way as a regular credit card, except that you have given the credit card company money up front to hold for you to extend you that credit. Here's what I mean. Let's say you open a $500 secured credit card, meaning they're going to give you $500 in credit. But because this is a secured card, you will need to give them $500 first, and then they grant you $500 in credit. Then you can use that card as if it were any other credit card. And you may or may not eventually get that $500 back. It depends on the card. But that's what a secured credit card is. They secure the money from you first and then grant you credit based on that. Doesn't sound ideal, but it's actually a really good way to rebuild credit that's been damaged or to get your credit started if you're having a hard time getting approved for something. I really hope this was helpful because this was information I didn't have when I was in my 20s. No one sat me down and told me any of this. And I know there's so much more information, but I wanted to consolidate it in my mom way because this is a topic I have spoken about with my daughters over and over and over again over the years. And also because I learned all of this the hard way, and I don't want that for you. Until next time, you're amazing, you're smart, you're capable, and I'm proud of you. Always remember to wear clean underwear and eat your veggies. Bye. On a Friday morning. Oh God, I think it's Friday. Is it It's Friday. Okay.